Stop wasting your money by ignoring how tax strategies shred your returns as a limited partner. You pour your capital into deals, startups, funds, expecting those gains to build your future, right? But if you don't master the tax game, you might as well be flushing a huge chunk of that money down the drain. It's brutal, and most people don't even realize what hits them until the damage is done. The question isn't if taxes will eat your profits, it's how much and what you can do to keep as much as possible. First, stop thinking about taxes as some boring separate issue you deal with after you make money. For limited partners, taxes are part of the investment, always. Your returns aren't just what's on paper, they're what lands in your pocket at the end of the day. And taxes can slice through your gains faster than you think. The worst mistake? Ignoring how the structure of your investment and your personal tax situation interact. Are you slapping yourself on the back because your fund doubled, but did you check the real post-tax return? Most don't. That's the kind of blind spot that screws you over. Here's what you actually need to focus on: the timing of distributions, the character of income, and how the fund is structured. Many limited partners freeze when taxes come up because it's confusing, but burying your head won't save you. You need to get ruthless about this. Did the fund throw qualified dividends your way or regular income? Because that makes a massive difference, whether you pay 15% or 37%. Did you get long-term gains or short-term? Are you sitting on K1 forms that you don't even understand, letting surprises hit you when tax season comes? Stop being passive. Demand clear reporting. Insist on funds that deliver net of tax projections, not marketing fluff. If you're not leveraging tax-efficient vehicles like IRAs, self-directed accounts, or even considering tax-deferred structures, if you don't have a plan to shift those gains into lower brackets or deferred periods, you're handing your money to the taxman. You need to work with tax pros who get private equity, who understand the nuances and the traps. This isn't about generic tax advice. This is about specialized aggressive strategies tailored to protect your limited partner returns. Another brutal truth: carried interest rules and state tax issues can destroy your profits. You think you're only juggling federal taxes? States want their slice, especially if you live or invest in multiple places. You must map where your partners and funds live, where income is sourced, and plan accordingly. Overlook this, and you're bleeding cash silently. Now, let's talk about timing. This is your weapon. Tax strategies around when and how distributions happen can save you tens of thousands, even hundreds of thousands on larger stakes. Deferring income into years where you expect lower rates, bunching deductions, and aligning your contributions can flip the whole game. Most limited partners never get this tactical enough because it's uncomfortable. But if you want to keep more of your upside, get obsessed with time. Tax seasons are moments to anticipate, plan, and maneuver, never a deadline to fear. If you feel stuck with the usual reports and no control, make noise. Push your fund managers for transparency on tax impacts, real cash flows, and distribution timing. Demand scenario analysis. What happens if tax rates go up? What if you hold longer? No excuses. Every minute you delay, you lose more. Here's the kicker. Mastering tax strategy isn't just about saving money. It's about claiming control. Limited partners who crush it don't wait for luck or handouts. They seize clarity, challenge the system, and build their own playing field. Don't be the one who lets tax misunderstandings keep you small. Get tactical, get professional. Map your personal tax landscape against every deal. Build a toolbox of strategies that create friction against the tax bleed. Every dollar saved on taxes is a dollar that fuels your next opportunity. Get aggressive on this, or get crushed by the system that's designed to take your slice before you even see it. You don't just want returns, you want returns in your hands, real freedom to use your capital for what actually matters. So stop ignoring this. Start owning it. Because in the world of limited partners, the difference between a good year and a great one is how well you play the tax game. Don't settle for less when you can take what's yours and then some. This is the edge nobody talks about loud enough, but it's the one that separates the winners from the rest. Get it right or keep losing. Your move. Subscribe to our YouTube channel and visit the featured link to discover more.